Is the euro finally ready to rebound after a month of beatings? Or is the US dollar going to reassert itself here? Welcome to Macro Money. This is Ilya Spivak, head of global macro here with tastylive. And the euro has had a impressive update here, as have most major currencies, against the US dollar after we got some job openings data that maybe took some of the air out of this. The Fed will keep rates so high as everybody will never borrow again levels. Needless to say, a bit of hyperbole there. But there is a bit of a threat emerging here for the euro in particular as evidence of the very dire situation that the Eurozone economy is facing continues to mount. And with that, we turn our attention in these global recession sweepstakes that we've been conducting here on Macro Money to German inflation, which is going to come across the wires here in the next day. And take a look at why this might be an important catalyst for the euro, but also an important telltale sign for where the global economy is as well, and give us a sense for where this very important part of the global growth pie is trending at a time when, seemingly from these job openings numbers, the U.S. economy is finally starting to feel the weight of higher rates. So, German inflation. Germany, of course, the largest economy in the Eurozone. And so as Germany goes, oftentimes so goes the entire region. That, of course, is subject to the forces of evolution, and that could change over time. Certainly there are other large economies in the area that might contend for the top spot, in particular if Germany continues to be as hampered as it is. But for the moment, it is still the growth engine to look at and power the Eurozone at this current juncture. So what we're seeing here, and a little bit of an editing note here, HCPI stands for harmonized CPI. So Germany releases its own set of numbers based on its own methodology, but that doesn't really enter into the ECB's calculus, and so it doesn't really matter from the trading perspective as much as these numbers, which are the parallel released EU harmonized numbers that basically use the same methodology across all Eurozone economies to calculate CPI, and that's what the ECB is looking at. So that's the number we're going to be looking at here. The expectation is that we're going to come in from 6.5 to 6.3% on the year-on-year number. There's no forecast here for the core, but generally speaking, you would expect them to travel in similar directions. They have diverged a little bit more so recently, so that'll be an interesting bit to monitor, in particular as it relates to setting the stage for overall Eurozone numbers, where there's also been a bit of convergence between the headline and the core numbers. And that really speaks to the makeup of this inflation. So if we take a look here closely, we can see that the biggest contributor in Germany was, in fact, goods. This is different than what we saw in the U.S. and continue to see in the U.S., where goods inflation has almost completely been squeezed out, and services, and thereby the labor market, is really the main thing that the central bank, the Federal Reserve, is concerned with. For the ECB, it's a different story. Here you can see the gray bit, which is goods, is a much bigger component going back to late last year, where inflation was peaking, than services. Services running much more modest. We see then, as deflation commences, both are deflating, but on the services side, things are deflating much more slowly. And so we've arrived now at a place where we just barely have a bit of an edge for goods still. It's a sector that's responsible for just a little bit over half of what's going on the inflationary side here, but not much more than that. The spread at this point almost half and half. And so what we see is that, of course, inflation is down quite significantly from the peak over 11% that we saw in the end of last year. But at 6.3%, it is still miles off from the ECB target of 2%. So one might think, okay, yes, we have disinflation. Sure, that's good news if you're the ECB and you're trying to fight it, but we're still miles away from being where we need to be. Should this not mean that the ECB has to continue to beat up on this economy to bring it lower? After all, this compares with 3.2% inflation in the U.S. And in the U.S., it peaked at 9, so it peaked lower than the 11 where it peaked in Europe. But of course, in the U.S., it is already at 3 from 9. And here it is into 6 from 11. So the inflation issue clearly still very much more concerning, bigger by more than double in Europe than it is in the US. What is the makeup of this inflation? Well, if we start to break this all the way down, some interesting things immediately jump out. Note that very big light gray area, which was the biggest component to inflation as we were seeing it reach a peak late last year, and where the contribution is also squeezed the most. Note that in this latest bar, this little gray area is very, very small as compared to where it was here. So this, curiously, is the housing, water, electricity, and most importantly, gas part of the equation. So as we start to talk about these ideas that the war in Ukraine is hurting energy prices and squeezing the German economy, and wouldn't the Germans love to get out of this whole Ukraine morass and start to work closer with Russia again? Well, falling gas prices have been the biggest part of disinflation since inflation peaked. So maybe not, because it seems like the problem at face value is not at all borne out in the data. What is left as the largest component of inflation here is actually food. And of the food component, I didn't continue to further break it down in the charts here for fear of everybody falling asleep at their monitors. The biggest component is breads and cereals. And again, it would be tempting to say that what's going on here is, of course, linked to Russia, because breads and cereals, that's wheat and fertilizer. And of course, Russia is a major exporter of both. Surely this is, again, somehow linked to the war. Well, not really, it would seem. So as we can see here, looking at the exports from various countries and imports from Germany of food, and of course, in particular, grain. First of all, we can see here that there's not a significant amount of import that is accounted for by cereals and grain. We can see soybeans, wheat, corn, all very, very small components of overall imports. I suppose baked goods are a factor here in so much as bread is a part of the equation, but again, only 3.6% of overall imports. Big for the category, not big for imports overall. What's more, the main contributing countries have Russia down at just 1.4%. And Ukraine is not even discernibly on this chart here. The main source is likely to be more Poland, France, when it comes to grains. And so perhaps to some extent, the Netherlands, and for baked goods, perhaps to some extent, also the UK. But this is not a story where disruption of supply from Russia is the reason that food inflation is up. Very clearly, that's not what's going on here. So there appears to be this last kind of remaining pocket that is the biggest contributor here, and one wonders what the ECB can really do about it. If you raise interest rates, you're not going to make people not want to eat, and you're certainly not going to convince Germans that a staple food like bread is something that they should substitute for. This is not something that's going to be encouraged by higher rates. You're probably not going to have Germans say, you know what, we need to start to shift to rice from wheat because the price of bread is too high. That's probably not in the cards. So one wonders then what the ECB can do if it were to do something about this particular brand of inflation. And yet, do something it probably is beckoned into when we look at inflation expectations. This is, of course, the problem that the ECB faces here, is that inflation expectations, when we look at bond markets and swaps markets, are actually marching higher. So if we look at overall Eurozone CPI here, that's the gray bars. We can see the same disinflation there that we see in Germany. We can see that this tends to lead from expectations by about 6 months. And so what we see then at this stage is a situation where the trend is actually anticipating that inflation might start to come back up if what we see in the 10-year German break-even in the five-year euro inflation swap holds. All of that seems to come together to suggest that, in fact, expectations are trending in the wrong direction, and that the ECB risks letting inflation become more so entrenched into expectations and become that much tougher to beat back down. That seems to demand that the ECB needs to convince markets of its inflation-fighting mettle, and so maybe what it needs to do is hike again, just to make its point that even though it's done a lot already, it is prepared to do more to get the markets to at least start to trend in the direction that they want them to, looking at expectations. The 10-year break-even, of course, the bond market's priced in inflation expectation. The five-year measure, the swaps market's version. And the ECB seemingly has the room to do this, because if we look at the way that financial stability and sovereign risk in the region has withstood what has been a blistering tightening campaign, it has been quite encouraging. So in the red here is the Eurozone Financial Conditions Index. When we're below that dashed zero line, that's financial conditions being tighter, so credit being more expensive, more restrictive of growth. And above it is credit being looser. We can see now that we're near the middle, but just a touch tighter on overall conditions in the region. We can see that against that backdrop, the telltale spread between Italian and German bond yields, which tends to be a measure of how risky it is that rising rates will create some sort of dramatic stress in the more debt-laden parts of Europe, so Italy and certainly some of the other southern European economies, though Italy, of course, is very much looked at as the problem child because, of course, it's done less, relatively speaking, to restructure its debt profile than have, let's say, Greece or Portugal or Spain even. And it's also the largest. So if you were to raise rates so aggressively that Italy would find itself having difficulty borrowing or find it expensive to borrow, then you would be in a relatively dangerous space because the ECB has to set monetary policy for everybody at the same time. And if there's stress in Italy at the same time that something with very little debt, like Germany here used as a benchmark, if the spread between them rises, that would imply greater risk in lending to one versus the other. So more of a risk premium attached to Italy than Germany. And that, of course, would make setting monetary policy devilishly difficult, because different parts of the Eurozone would then need different rates, but there's the one ECB and the one rate. So that would create all manner of instability, again, akin to what we saw in the 2010, 2011, 2012 Eurozone debt crisis. As it stands now, what we've seen is rates are cautiously restrictive, not as restrictive as they were late last year, but a little bit on the restrictive side. Meanwhile, we've not seen a jump in Italy versus Germany yield spreads. We've not seen a jump in the financial stress index. And so it appears as though at this stage, the ECB is being told by markets it has to tighten, it has to raise rates if it wants to get these inflation expectations going down, and it has the cover to do it. Because at the very least, from a financial stability and a sovereign risk perspective, there isn't anything that would suggest the ECB should be afraid to act. Rather, the fear comes from someplace else, from the economy itself. Looking at the latest PMI numbers here, we can see the Eurozone economy, looking at the composite here, now for the second consecutive month, reading in contraction. PMIs, just as a quick reminder, operate around an axis at 50, where 50 is neutral, above 50 is growth, and below 50 is contraction. What we can see here, then, is that not only are things contracting, the further you go under 50, the faster the contraction, the further you go above it, the faster the expansion. We are now below 50 and accelerating. So from the looks of it, it seems like services continues to be the main driver here. It is the larger part of the economy than manufacturing. And as services sinks into contraction mode, it is unable to offset what has been malaise in the manufacturing side of things for quite a few months already, basically since the middle of last year. So we are now in a space where, from the PMI data, we've seen 2 consecutive months of contraction in Eurozone activity into the second quarter, June and July, where this is particularly worrying, of course, or July and August, rather, where this is particularly worrying, of course, is that Germany's economy already shrank in the second quarter. So what this implies is that that weakness is spreading, and that perhaps the entire region is already in recession. It would be an incredible turnaround to then see September numbers that make that risk go away. It might not be as deep of a recession, but after 2 months showing contraction on the PMIs into the third quarter here, and with Germany having already contracted in the second, it does seem like recession is already underway. Now, from the market's perspective, they have actually given the ECB a bit of an out here, because they have looked at the need for perhaps a softer touch when the growth situation is already this dire. And perhaps they've considered that inflation is being held up by factors that the ECB can't have much agency over in any case, as we've just discussed. And so with that in mind, they've actually downshifted ECB rate hike expectations since the last meeting. In fact, we can see here, not only are we down relative to where we were when the ECB last met late last month. The ECB meeting is the big dots line, and the current level is the solid line. You can see that there's still a little bit of a probability for a hike. So we're currently at 375. We're just under 4 looking 3 months out or 6 months out. So it looks like maybe there's a bit more of a probability to go up to 4. So maybe one more hike here, still being more so priced in than not. But then after that, that's the peak. And subsequently, a year out, we're already looking at a net cut relative to now. And 2 years out, we look almost a full percent and then some lower. So sort of flirting with the possibility that we're down 75, 100, maybe even 125 basis points over that time. And the back end of the outlook has become even flatter over just the past week than it was before. So the markets are looking at this and basically saying the ECB at this point is probably going to err on the side of growth rather than the lingering bits about inflation. And if we look at the probabilities for rate hikes here, we can see that we, at this point, aren't fully pricing in another hike. We were as recently as a week or two ago. At this point, the probability peaks out at 75, 76% in December. You can see the markets are leaning toward one more hike and leaning toward seeing that hike in September. You can see the probability that the hike happens in September, currently 42%. The probability that it happens in October is 26%. The probability that it happens in December is only 8%. But cumulatively, by December, the probability that there is a hike is 76%. So, with that in mind, there is room for this to correct if, especially, German inflation undershoots on expectations. And there may, in fact, be some reason to suspect that that's exactly where we're heading. Here is the Eurozone Economic Surprise Index. That's the bluish, grayish area there. And I've put a 20-day moving average on it so that you can see the overall direction. And then what you see in the back there is a Bloomberg survey forecast for German GDP. The yellow is for this year. The red is for next year. What's interesting here is that we have seemingly still a tendency for Eurozone economic data to undershoot expectations. So you can see the blue area is below the zero line. What this means for this Citigroup indicator of economic surprises is that as economic data comes in, it still tends to be weaker than baseline forecasts. That's the index below zero. There's zero. What you see here, though, is that it's become less bad over time, which means that essentially data still tends to undershoot, but it has come in closer to expectations than it was, let's call it June, July. But that may not necessarily be as good as it seems. This can happen either because the data has become better or because the expectations have been lowered. And what we can see in these GDP expectations is they have, in fact, been lowered. So just as this correction starts to happen, we can see a downgrade in baseline forecasts for this year. So we've moved to a lower shelf here. Similarly, we can see that there's been a downward adjustment in next year's GDP expectations from here to here over this same period. So just as these adjustments are made, so too we get a bottoming and a reversal. So in simple terms, what this means is that, yes, maybe there's been a little bit of an improvement at surface level in the performance of German economic data relative to forecasts, but that may be because the forecasts themselves have been brought lower, and so it's a little bit easier for the data not to undershoot by such a wide margin. And it still is tending to undershoot. So the risk still seems overwhelmingly to suggest that if there's going to be a surprise, it's much more likely to be a weak surprise than a strong one. With that in mind, we might be in a place, since the markets clearly seem willing to respond here to negative economic data or signs of a weakening business cycle with adjustments to a more dovish policy setting, and with the probability of another hike still quite high at 76%, there's clearly the possibility for a dovish adjustment in this outlook. Which brings us to where the euro is today. So we can see we found a little bit of a bottom, a little bit of a support just underneath the 108 figure on this 6E future. This is the euro as priced in US dollar terms. And we've bounced to retest former support now acting as resistance just underneath the 109 figure. Now, there is maybe a little bit more of a barrier here just around about 109.50, where you can see there's that former swing bottom here. So if you had to guesstimate another layer of former support become resistance, you might say somewhere around here is another barrier. But somewhere in here is where the trend is essentially being retested. And what we're looking at is perhaps former support will hold up and we're going to return back lower. So from somewhere here down, or if we break out, then from here someplace up. And so what we are looking at is perhaps a place where somewhere in here there is room for the euro to find resistance and come back down. If that's going to be the case, then a straightforward catalyst for the move might well be German CPI data that undershoots expectations, gives us a less significant level of conviction in seeing another hike. It probably doesn't, of course, come down to zero instantly, but to the extent that it can adjust back from the current 75 down to, let's say, 65, 50, then we could certainly have this be the place where the euro runs out of steam, give or take, and there begins another leg in the down move, initially perhaps targeting a return to these lows underneath the 108 figure. And then if that can be broken through, then perhaps looking at the late May, early June bottoms underneath 107, closer to about 106.50. And that is macro money for today. We are here every day, Monday through Thursday, just after overtime, a show that I do with head of futures and Forex, Chris Vecchio, where we try to figure out what the markets did after the Wall Street close and make sense of where they might be going next. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and opining sporadically on Twitter, yes, Twitter, at Ilya Spivak. If you're watching this on YouTube, jump in the comments, give your opinion. Do you think that the ECB is going to act again? Do you think it won't? Do you think the euro is done falling here and the dollar is on the defensive, or is the dollar going to reassert itself and the euro give back these preliminary gains? Very happy to hear your thoughts, and we'll incorporate them into the show going forward. Thanks very much, everybody. See you tomorrow. Happy trading. Take care.